So guys, as you know, Fiverr has just released its Q2 numbers, and well, that's what we're going to cover today. Fiverr is a position of mine. I'm long on this stock. I'm long on Fiverr. My entry price stands at around $27, $30, around this area here. So that means I'm like 70% in the red, right? But anyway, today we're going to talk about the highlights of their Q2 numbers, and in the end, I will also share with you how I'm thinking about this position. Before I begin, as always, nothing in this video is investment advice, okay? And with that said, let's get started. So, as everybody was expecting, Fiverr's numbers have continued to deteriorate. For example, the number of active buyers declined 22%, ugly number. However, that was partially compensated by the higher spend per buyer, which stood at $368, as you can see here, an increase of 15.6% year over year. So that's why Fiverr's revenue ended up dropping only 10%. Now, what can I say, right? Nobody likes to see revenue going down. But you see, the bad news is that this trend will likely continue. And I'm saying that because, as we can see here, according to the company, they're expecting to close the full year of 2026 with a decline in revenue between 14 and 17%, okay? Not good at all. For the third quarter of 2026, they're expecting a drop in revenue between 18 and 26%. So yeah, pretty ugly numbers, right? However, with that said, not everything is bad news. Now, how could that be so? These are really ugly numbers. But you see, I'm saying that not everything is bad news. Because, for example, though revenue went down, Fiverr has still posted an excellent gross margin of 82%. The company also posted operating profits with an operating margin of 6%. And here let's recall that a little more than a year ago, the company was still posting operating losses. Besides, Fiverr also posted net profits with a net margin of 4.57%. So that's why I'm saying that not everything is bad news. Moving on, the company is still delivering free cash flow. Last quarter, they delivered $13.6 million in free cash flow. Okay, 80.2 million of that is related to stock-based compensation, but still. And finally, Fiverr also ended the quarter with a very strong cash position. Here, they ended the quarter with $306 million in net cash. So yeah, I think they have enough cash to weather the storm. So yeah, not everything is bad news. Now, I think these were the most important numbers, okay, of Fiverr's latest results. And with that said, let's here recall why that's happening to Fiverr, okay? So Fiverr's marketplace is shrinking because of AI. So that's why this stock is selling off, because of the market's fear of AI. As you know, Fiverr is a marketplace of freelancers, and well, AI has emerged and it is disrupting everything. And for Fiverr, AI is especially problematic because AI is taking over a lot of the gigs that are offered through Fiverr's platform, especially the low-skill gigs. For example, image editing, text translation. Who is going to hire someone to translate a document when you have ChatGPT? It simply doesn't make any sense. So that's why Fiverr's marketplace is shrinking. And you know, I'm seeing a lot of investors who are like extremely bearish regarding this company, regarding Fiverr. And I get their argument, which is that, man, AI will evolve so rapidly and it will become so intelligent that soon, okay, it is now taking over the low-skill gigs, but it's likely just a matter of time before AI starts climbing the skill ladder and also starts taking over the more complex gigs. So in other words, AI would completely make human labor obsolete. And because of that, freelancers and Fiverr's marketplace would become irrelevant. So that's why I'm seeing a lot of investors saying, for example, that Fiverr has become an uninvestable company, no matter the price. And you see, that's where I disagree with them. Because I don't think Fiverr has become an uninvestable company, no matter the price. For me, Fiverr is still a very investable company. The question is, at what price? But anyway, we'll soon talk about that. But yeah, Fiverr could end up taking over everybody's jobs, right? Now, if that happened, I think I would have much more important things to worry about. But that's a possibility. However, another thing could also happen. That is, AI could start creating demand for completely new skills. And that's what I think is happening in Fiverr's case. For example, here, clients completing projects over $1,000 in programming and tech grew 34% year over year, while graphics and design grew 25%. Demand for AI user-generated content video ads surged 265%, while AI video ads rose 63%. Moving on, search volume for AI voice agents jumped 49%, AI mobile app development rose 92%, and AI website development grew 39%. So that's what I'm talking about. I think that, yeah, AI will destroy a lot of gigs. However, it could start creating demand for entirely new skills. And Fiverr could end up actually becoming one of the places, one of the platforms where this highly skilled talent can be found. And you see, that's another possibility. That could also happen. And in that case, I think that Fiverr's business would eventually stabilize. The company will start operating probably in a very different scale. However, in that case, Fiverr would still survive. But okay, now the question is, what is this company doing to survive the AI threat? So that's what we're going to talk about. You see, I really like this sentence here because I think it summarizes pretty well the moment this company is going through. Put simply, AI is automating simple tasks, and Fiverr is moving toward larger, longer duration projects where AI deployment meets human judgment, strategic partnerships, and accountability. So, what's Fiverr's plan? Fiverr's plan is to focus first on longer term projects, more expensive projects as well, and they're also focusing now on high skill gigs. So the company will not try to swim against the tide. It will not try to save the $50 gigs. Instead, it is now focusing on this high skill division. Now, what do I mean when I say high skill? So, this is the kind of job that is now being hired through Fiverr's marketplace. Here. For example, 1. A growing distributor that recently used a multidisciplinary freelance team on our platform to architect their entire B2B wholesale inventory and logistics ecosystem. This isn't just custom code. It is deep operational software running their day-to-day supply chain, ultimately setting up for a phase 2 rollout of a retail point of sales. So this is the kind of job of gig that is now being hired through Fiverr. So they're now focusing on these longer, high-skill gigs. That's the first thing. Besides, they're also trying to improve their matching skills, and they're also trying to become more than just a marketplace. So they're trying to become the platform, the place where all these projects are managed, so the business can become stickier. But yeah, Fiverr could end up surviving AI. Now the question is, at what price would it be interesting, would it be safe for us to buy Fiverr stock with a good probability of making money, even under bad assumptions, even under bad premises? So that's what I'm going to try to answer now. So I can try to decide what to do with my position. So now I will use the enterprise value to sales multiple to evaluate the stock. You can use other multiples, you can use other methods, but I will use this one. But anyway, as you can see here, Fiverr has delivered $420 million in revenue over the last 12 months. 65% of that corresponds to their marketplace, and 35% of that corresponds to their services division. Now, regarding the marketplace, 85% of it consists of low-skill gigs that are now being replaced by AI, okay? While 15% of their marketplace consists of high-skill gigs. Now, let's say their low-skill gigs division decreases 30% per year for the next 5 years, okay? Meanwhile, let's also say that their high-skill division grows at 15% per year. Now, let's assume that their services division will stay stable, okay, at 30% of the company's total revenue. And let's also consider that the company's net cash position decreases by 5% per year for the next 5 years. So in that case, Fiverr would get to 2031 with $172 million in revenue and $236.7 million in net cash, considering 36.3 million shares outstanding, and also considering a future enterprise value to sales multiple of 0.5 times. So under these assumptions, we would get to a future fair price of $8.90, bringing that to present value using a 10% discount rate. That would mean that the fair price to pay for Fiverr stock, considering these premises here, and using a 10% discount rate, so the present fair price would be at $5.50. Oh, but Fiverr is trading at an enterprise value to sales multiple of like 0.05 times today. I don't know. It is almost trading at a negative enterprise value, this company. So it could trade at much lower multiples than that in the future. I know, but it could also trade at higher multiples. So you see, I'm just trying to be reasonable. So that's why I considered a multiple of 0.5 times. But maybe this company could trade at 2 times enterprise value to sales. But anyway, under these assumptions, I think we could buy Fiverr stock at $5.50 with a good margin of safety. In the end, it all depends on what you think will happen to AI and the human labor market. And by the way, nothing in this video is investment advice. Let's recall that. But anyway, but that's actually pretty interesting because you see, to invest in Fiverr is actually a bet on the future of work. So it kind of depends on what you think is going to happen regarding AI and human labor. Now, many of you will say that, man, you shouldn't value a company using sales because in the end, it's not about how much the company makes in terms of revenue. It's about how much is left in the end. It's about profits. It's about free cash flow. And that's actually pretty reasonable. So that's why I tried to value this company also using the enterprise value to operating cash flow multiple. So let's keep the same assumptions, okay? But let's consider that Fiverr's operating cash flow margin decreases by 10% per year for the next 5 years. So in that case, Fiverr would get to 2031 generating around $21 million. Now, considering an enterprise value to operating cash flow multiple of 3 times, that would put this company's future fair price at $8.25, bringing that to present value using 10% as our discount rate to a present fair price of around $5. Oh, but the company could start burning cash. Yeah, that could happen. So that would make this method here kind of useless, right? But you see, the important thing for us is kind of to have a feeling of what this company's valuation is pricing in at this and that level. I think that that's what's important for us. It's about what premises the valuation is pricing in. And it's about whether you disagree with these premises. But anyway, now the question is, to close this video finally, now the question is, what the hell should I do with my position? So you see, here's how I'm thinking. I'm in a moment of low liquidity, so if I'm going to buy a stock, I really need a very good reason to do that. At the current price, I don't think I have a lot of margin of safety regarding Fiverr. I mean, I would like to buy this company priced at more pessimistic assumptions. That's what I would like to do. So what am I going to do with my position? Should I sell my position? Well, no, because this company is still trading at crazy cheap levels. It is almost trading at a negative enterprise value. So it is very cheap indeed. It could still rebound. So no, I'm not going to sell my existing position. However, I'm not planning to buy more shares at the current levels. I actually had a limit ordered at $9, $8.50, somewhere around that area. But I decided to cancel it because after thinking a lot about this company's valuation, I just felt that I needed more margin of safety. So that's what I think I'm going to do. I think I'm going to wait. And well, if this company gets to $5, well, who knows? I think at $5, we would have a very good margin of safety. But anyway, again, let's always recall that nothing in this video is investment advice. Okay? And with that said, see you next time.